You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome to the show, John.
Hey, Jim.
Corporate earnings, not all that bright and shiny anymore.
Yeah, that's the big story right now, among a lot of big stories out there. Basically, corporate earnings have been growing dramatically for the last 5 or 6 years, and that's propelled stock prices higher, especially in the U.S., but really around the world. And now that's plateaued and starting to roll over. Corporations are making a lot less money this quarter than in the quarter a year ago, especially in the U.S. because the dollar is so strong. That's one of the things holding back corporate earnings. But Walmart, for instance, just announced flat sales and falling earnings, which for them is huge because they normally add so many new stores continuously that their sales go up and their earnings continue to go up year after year. But now that's changed, and they're predicting lower earnings for the next couple of years. So their stock tanked on that news, wiped out $20 billion of market cap in a single trading session. Goldman Sachs, the big investment bank, saw its earnings drop 38% year over year. Morgan Stanley's profit down 42% year over year. So what this means is that the main driver for share valuations in the U.S., especially, it has now been taken away. It's hard theoretically to have a rising stock market if the companies that make up the stock market are making less and less money year after year. And so for equity bulls, for people who are buying into the stock market right now, this is a really dangerous time because the main underpinning of the market has been taken away. And the reason corporate earnings are dropping is, first of all, because the U.S. dollar is so strong. It makes it hard for companies to sell things overseas. And second of all, because the global economy is slowing down. China was really the driving force for the recovery post-2008, 2009. They borrowed $15 or $20 trillion and spent it on infrastructure and, in importing raw materials from all over the world. And they basically had to stop that because they borrowed as much as they can borrow. Their stock prices are down, and their economy is because of that slowing. And so, without China to prop up the global markets, the U.S. isn't making that much money anymore either. Nobody can be profitable in a world where most countries aren't growing very quickly, and where China, which was the big growth story, might even be flat. They're reporting actual positive GDP numbers, but everybody knows that the numbers that they report are just made up. And under the surface, most things are negative in China. So I think you can say with some degree of certainty that they're shrinking now. And so the global economy, by extension, is flattening out and starting to shrink too. So that's a very big story, because if it translates into lower stock prices, then we get the potential for a real crisis, because the system is so highly leveraged. We've borrowed so much money that we probably can't survive a garden variety bear market. Let stocks go down 20 or 30%, and that would set off a cascade failure of a bunch of big leveraged speculators out there, which in turn would pull down the rest of the global economy. So we're terrified, or at least the leaders of most of the major countries are terrified of even a normal fluctuation in the stock market. Bear markets are very common occurrences. Stocks drop by 20% on average every 4 or 5 years. And let that happen now, and the consequences could be a lot more serious. So corporate earnings bear watching.
Well, whose fault is it that they put in all that quantitative easing that kept the cycle from going down naturally in 4 years? We're 6 years out, almost 7 now. Mm-hmm. And people warned for the longest time, the more you support a market that wants to go down, the bigger and harder the crash eventually will be.
Well, that's the box that the world's governments and world central banks are in right now, because they can't let markets be markets. In other words, let markets fluctuate and go down sometimes, because that'll cause a broader financial crisis that terrifies them. But if they keep propping markets up, they get valuations that are more and more out of whack with reality, and that will, like you said, lead to an even bigger crash out there in the future. So that's what we've been doing really for the past 20-some years. You know, going back to the 1990s, we've been preventing normal and natural processes in the markets where somebody makes a big mistake and they suffer for it. You know, we're not letting anybody suffer anymore. And because of that, we've created the conditions for an immense crisis. When the next one hits, it's going to be worse than 2008, 2009, which was already the worst financial crisis since the Great Depression. So very big, very serious things are coming. And one of the catalysts could very well be falling corporate profits in the major economies. And that could set off a chain reaction that ends who knows where.
Well, didn't they tell us that low copper prices and low oil prices were the predictor of this?
Yes, yeah. And that's because China stopped buying so much copper and iron ore and oil, and, you know, pretty much name the commodity. China was the big buyer over the past 4 or 5 or 6 years. And they went from buying something like 10% of the raw materials in the world to buying 40% at the peak. Now they're heading back down to 10%. So that is what pushed prices up for a lot of these raw materials and led the makers of raw materials to invest in a lot of new mines and smelters and transportation equipment and, you know, what they needed to be able to supply China. Well, China doesn't need their stuff anymore. So a lot of the fixed investment in the raw materials world turned out to be malinvestment, turned out to be something that will never generate the cash needed to pay off the related debt. And so the oil patch, for instance, where, especially in the U.S., but also Canada, where you guys had a big tar sands boom, we had our fracking boom down here. And a lot of the equipment that was bought and the land that was leased and the structures that were built, a lot of those things are not going to generate positive cash flow in the near to intermediate future. And so a lot of the debt that's related to that stuff is going to go bust here pretty soon. And so we'll see that in 2016. There's a lag between a fall in price for a commodity and the economic consequences, because most of these guys have some cash on hand, they've got some credit lines that they can draw on, and so they can stagger along as, you know, walking dead companies for a while, but eventually they keel over. And we'll see that in 2016, and that's going to be one of the catalysts for the next down leg in economic growth if nothing happens to offset it, because especially in the U.S., the oil patch was the source of most of the good new jobs we added. You know, we've added a lot of jobs down here, but a lot of them have been bartending and waitress jobs, you know, stuff that most people don't think of as a career or as a way to support a family. But in the oil patch, those were good jobs. You know, we were hiring people to be to work on oil rigs, and petroleum engineers were the hottest field, and all the support people who were setting up things that made it easier for all these new oil rig workers who were flooding into Montana and the Dakotas and places like that to live. Those guys all made good money. And now none of them are making good money. So we're going to see a big impact on U.S. employment in the year ahead and on economic growth just from the oil patch. And meanwhile, you got lots of other sectors that are looking weak. And, you know, one of the things that is also weighing on the service industry, like McDonald's and Walmart, is the fact that corporate profits have gone up so dramatically, really at the expense of workers for the last 4 or 5 or 6 years. And workers now want their piece of the pie. And so you're seeing higher minimum wage laws be very politically popular in the U.S., and workers protesting and going on strike at fast food restaurants and big retail chains demanding higher pay, and they're getting it, you know, and so that's another thing that's going to make it hard for the corporations, some of the corporations who have made lots of money in the past few years or decades, to keep on making that kind of money, because now they have to give back some of their excessive profits to their workers. And that is going to the extent that they keep the same number of people working, which in a lot of cases they won't. They'll lay off people to offset their higher wage costs. But to the extent that they keep the same number of people working, that means lower profits for them. And so that's part of why Walmart is projecting weak results for several years, and part of why McDonald's looks like it's in crisis right now, especially in high-cost U.S. markets, where a lot of the franchisees say they can't turn a profit under the current circumstances. And so, yeah, there's a lot going on that all points towards weaker corporate profits and therefore weaker stock prices in the next couple of years.
What about all these companies that during the good times went and spent an extraordinary amount of money to buy back their own shares?
Well, that's how they propped up earnings when their sales started to turn down, because they could borrow money very cheaply, and they did that, and they used the proceeds to buy back their stock. So the earnings that they were generating were then calculated on fewer and fewer shares to get earnings per share. And so earnings per share, which is the main number that everybody looks at when they're trying to relate earnings to the price of the stock, that continued to go up even while sales and in some cases operating profits were going down for these companies. Well, now they've borrowed so much money to buy back so much stock that the interest costs on that debt, even though it's low rate debt, it's still mounting to the point where the interest cost is starting to more than offset the savings of buying back stock in terms of earnings per share. And so now these companies are really highly leveraged. They've got too much debt, and the cost of that debt is actually lowering their earnings. So they're kind of stuck. There's not a way out of this in the short run, because nothing they do right now will raise their earnings. And investors are starting to figure that out. So you're seeing a lot of these companies who report bad earnings and then explain it in a way that makes it look even worse, and then their stock price tanks. And that leaves them with very few options, because normally if you've got too much debt and it's affecting your earnings, you try to issue shares in order to pay off some of your debt. Well, your stock price is way down. You've bought back shares over the past 3 years at prices that are higher than the current price. So now are you going to turn around and buy back or issue a bunch of shares at a lower price? It's going to make you look kind of stupid and create a loss on your balance sheet that will have to translate into lower earnings going forward as well. So, there's no real solution when you make stupid mistakes, right? You just have to kind of own up to your mistake, go through the pain of fixing whatever it was you did, and then hopefully come out at the other end with some kind of a sustainable structure in place. Well, that's what U.S. corporations have to do now. They made what is going to look like, in retrospect, a horrendous mistake by borrowing huge amounts of money to buy back huge amounts of stock at extremely high prices in the last few years. So now, if there's a bear market, these companies will basically look like unsuccessful hedge funds. They use leverage to place a speculative bet on the market and lost big. And so regardless of what their core business does in that time, they're still going to have this big financial hole blown in their balance sheet. And so that's going to translate into a lower market value. So no matter how you slice it, the mistakes of the past few years are going to come back to bite U.S. corporations and by extension, U.S. government and, of course, U.S. workers, because they always suffer from whatever mistakes are made at the top.
And I was going to say, too, part of the problem is the structure. CEOs get bonuses based on the price of their shares. How about basing their bonuses on keeping the cost of the company down?
Yeah. There was a theory a while ago that said that if you align the interests of the guys running a company with the interests of shareholders, in other words, have everybody base their income on the stock price, that you would be okay, because then everybody would be working towards the same thing, which is a higher value for the company. But it turns out there are lots of financial engineering techniques that CEOs and other executives can use to pump up the value of their stock in the short run, pay themselves huge year-end bonuses based on a higher share price, and then bail on the company after a few years and leave a huge mess to their successors. And that's what's really happening. So these guys basically have gamed the system. And so going forward, there's going to be a debate over how best to pay executives if the stock price isn't your main indicator anymore. And yeah, so maybe you're right. Maybe it's some measure of efficiency that should be used. But, it's not clear what they're going to decide on yet. It's not clear what's going to come into vogue next. But I think it's safe to say that they will still try to game the system, whatever the system is, and that in a lot of cases they'll succeed.
John, you need to do a book on the corporate conspiracy, how the CEOs get together every year and say, if you're a CEO, I mean, here's the perks. You get a bonus on this, but, the golf club membership isn't enough, and the Jaguar's pretty pale, so it has to be a Bentley, it has to be a yacht next year.
Years and years and years ago, I used to write for a magazine called Virginia Business down in Richmond, Virginia. And we'd do a highest paid executive special every year. And for a couple of years, that was my job. And it was clear from doing that they had come up with a beautiful scam. These corporations would, when they were deciding how to pay their executives, they would go hire a consultant to look around at the other companies in the field and figure out what their executives were paid. And then the first company would pay their executives that amount plus some extra bit because their executive was better than those other executives. And then that would become a comp, which for the next company that had to decide how to pay their executives, the consultants would go and look at this company that paid even more, and that would raise the average. And so they had this kind of circular thing going where one executive's raise became the next executive's raise because it went into the comps that the consultants were using to figure out what fair pay is. And so that's what ratcheted up CEO pay over the last couple of decades. This kind of inside game that they were all playing. And so now you get a situation where the average CEO pay is something like 300 times the pay of the average worker. And so that they're completely disconnected from the welfare of their workers. In fact, executives in the U.S. tend to be higher paid to the extent that they lay off more people or shift more jobs to China or wherever. So you get the spectacle of executives being rewarded for firing their workers.
Well, here in Canada, when Target closed, the CEO of Target Canada got a bigger severance paycheck than what was paid to all of the workers they had.
Yeah. And that's not surprising. That's really not out of character with what these guys do now. And they get away with it. You can run a company into the ground, but you walk away with a golden parachute where they pay you $40 million to go away. And so you basically didn't suffer at all due to your own mismanagement. Just everybody else did. So yeah, we have kind of created an aristocracy of corporate CEOs and bankers and politicians who have no downside. The banks can commit any crimes they want to, and they pay a small fine relative to the money that they made committing the crimes. And none of their people go to jail. The guys who actually committed the crime within J.P. Morgan Chase or Goldman Sachs or wherever aren't even named, let alone jailed. And politicians can basically pass laws that make life easier for their banking patrons and then leave when they're, if say they get voted out of office because it's clear they're doing a crappy job, well, they go to a consultancy or a lobbyist and work for them and end up making 5 or 10 times what they made as a politician. So there's no downside to bad decision making for the people in the modern economy's aristocracy. And that's what has to change somehow. Somehow there has to be accountability in which guys who screw up pay a price for screwing up. These bankers need to be put in jail and impoverished. All the bonuses they got for the 5 years previous to their conviction while they were committing the crimes need to be taken away from their families. And politicians need to go back to their original lives rather than staying in Washington and being part of the lobbying community. And see, the idea of that happening, though, is so far-fetched because politicians would have to vote for that law.
Well, in Britain, they do have a law like that. If you're the CEO of a bank that goes bankrupt, you face up to 3 years in jail.
Yeah, okay. And the point being that your bank should never take the kind of risk that could lead to bankruptcy.
Exactly.
And if you took that kind of risk and ended up going bankrupt, that means you did something you shouldn't have done, by definition. So yeah, that would help. But the idea of it being enacted, especially in the U.S. again, it's really far-fetched at the moment, because the banks are the biggest contributors to both the major parties. And unless we were to elect a Bernie Sanders or an Elizabeth Warren here, you would never see anything like that happening. And even if we elected somebody like Bernie Sanders, who's running a not too distant second to Hillary Clinton right now for the Democrat nomination, he would still run up against a Congress and a Senate that have basically been elected with Wall Street money. So the odds of him being able to succeed in putting in place a British-style banking law, they're pretty long. You know, it's hard to see it happening. So I think we have to have a huge financial crisis that brings the current leadership of corporations and banks and government into complete disrepute before something is put in place that produces real capitalism. You know, a libertarian world can only happen when these big power structures are broken up and whittled down. And that can only happen when the market does it. It'll never happen politically until the market has already crushed these guys. So, in that sense, and in a broader philosophical sense, crises are great things for capitalism, because you need the people who have screwed up to crash and burn so that everybody else can see what not to do. And we have short-circuited that process for the past 30 or so years. And so you've got people doing anything they want to with no sense that there's any downside to their actions. So let a market crisis come along that actually does add a little downside to bad decisions, and you'll see us clean up our act in short order.
We'll have more with John Rubino right after the break.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with John Rubino. John, you said negative interest rates are here. Can you explain what's happening?
Well, around the world, interest rates are negative in various places like Switzerland and Denmark, and to an extent Germany and France. And that's because capital from other parts of the world want to flow into and hide out in these perceived safe havens. So that has pushed interest rates down to negative territory, because people are willing to pay a little bit just to store their money in German bonds or Swiss francs or whatever. And that hasn't come to the U.S. yet, but it's beginning to come. And it's come in the form of big banks telling big depositors that they don't want their money anymore. So if you're a big corporation, let's say, and you just borrowed a lot of money through the bond market, and you haven't used it all to buy back your stock yet, you got to keep it somewhere, right? Well, try keeping it at a bank in the U.S. now, and that bank is going to tell you, we don't really want all this new cash, so we're going to charge you a bunch of fees to make it worth your while to move it to somewhere else. So those fees, when you add them all up, come to a negative interest rate, basically, functionally. So corporations who want to store their cash in large U.S. banks now face a negative interest rate. And so what that means is that negative interest rates have arrived in the U.S., and they're going to spread from here, because very few banks actually do want cash anymore. The government has given them so much cash that they don't know what to do with it. And so to take in cash from even a small depositor now, you know, if you deposit some money in a local U.S. bank, you want to buy a CD with it, well, the rate on that CD is going to be very, very low. So the bank isn't going to make any money. And so why bother? From their point of view, you know, there's a lot of administrative costs that go with having a small bank account from their point of view, and if they're not going to earn any money on it, why bother? And so
it sounds like the banks have the same problem as drug dealers. Too much cash. They don't know what to do with it.
there's a show called Narcos, which was, I think, made by Netflix. I just binged it a while ago here, and that did happen in Colombia during the days of the Medellin cartel. They had so much cash coming in, they couldn't launder it. They couldn't buy legitimate businesses fast enough, so they ended up digging big holes and just burying the money. And so banks are kind of in that spot right now. The government has given them immense amounts of dollars, and they've just turned around and deposited those dollars with the Federal Reserve because they can't lend them out. There are no legitimate businesses to lend money to from the point of view of a bank lending officer right now, beyond what they've already lent. And so, we're lending lots of money to students who will never be able to pay back their student debts, and to car buyers who are going to be locked into their car for 7 years, assuming they can make the payments for that long. But there's not much else. And so there's no reason for a bank to attract deposits with which to make loans, because they're not making any more loans than they already have made, and they've got plenty of cash on hand to make whatever else they want to make. So in the U.S., we will see interest rates drop from here, especially as the economy slows down, and turn negative next year. And so we'll join Germany and France and Switzerland in having negative interest rates on a lot of accounts. And that's this huge distortion to the way markets are supposed to work, because we've never had this anywhere in the world on a sustained basis where a major economy operates with negative interest rates. Well, next year we're going to find out what happens when we try.
Well, if the banks don't want to look after the cash, they can give it to me, and I'm sure you'd take it too.
Mm-hmm. I'll hold it for them
if that's a problem.
See, that's the fear in an interest rate or a negative interest rate environment, is that everybody just takes their cash and goes home, and so that the banks then lose all their customers. And in normal times, that's terrifying to banks because they operate by taking money from customers and lending it out. But now it's possible that banks just won't care. So we'll see. I don't know. I think the unintended consequences of a drop into negative interest rates for a major country will be outrageous at some point. And the question is, what will they be? What kind of instability will ensue when most short-term and some intermediate-term interest rates are negative? And what happens if it goes out to 10 or 20 years? Briefly in Germany, it went out to 10 years. And in Switzerland, if you wanted to buy a 10-year bond from the Swiss or German government, you had to pay them. They weren't going to pay you. So I don't know what any of this means, Jim, except that it probably will be very, very bad.
And it'll
probably be very good for gold and silver, because it used to be that the cash flow difference between a bond yielding 6% and gold stored in a vault that you had to pay 1% to store per year, that was pretty outrageous. That was a 7% spread that made the bond look really good relative to gold. And now, if bonds are going to be 0 or negative 1%, and gold is still going to be 1%, negative 1%, then suddenly storing precious metals in a vault rather than holding on to some depreciating currency-backed financial instrument, that's going to be a really, really good deal. So I would think that negative interest rates will be spectacularly good for precious metals, and which will then lead the governments to try some way of making precious metals unattractive to hold. So, the war on cash, which is going on now, will morph into a war on gold. But again, this is just speculation. We can't know how this is going to play out until it plays out, because we've never been there before. There are very few theories that really apply for something like this, because most theories are based on past history. If a pattern repeats, then you figure out why it repeats, and you expect it to continue. Well, there's no pattern here that we can look at and say, oh, well, the last time most major countries had negative interest rates, this happened. There's never been a time like that. So this is uncharted territory, fascinating from a theoretical standpoint, and terrifying from the standpoint of anybody who has to live through it with their financial lives intact.
Just like the crew members aboard Columbus's ships, huh? Didn't know what was over the horizon.
Are they going to fall off the edge of the world, or what? They didn't know until they did it.
John, thanks a lot for chatting with us.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble His website, dollarcollapse.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.